Hi, all. Thank you for joining us for today's webinar, CCUS Tax Strategies, Opportunities, Roadblocks, Hurdles, and Solutions. My name is Alex Krauke, and I'm a consultant for USEA's Consensus Program. The Consensus Program seeks to educate the public, policymakers, industry, and other stakeholders, and build both a domestic and international consensus on the wide array of benefits of carbon capture, utilization, and sequestration, CCUS for short, and clean coal technologies. We do this by hosting and producing a variety of briefings, workshops, and reports, as well as a monthly newsletter. If you would like to subscribe to our mailing list, please email my colleague, Michelle Littlefield at mlittlefield@usea.org. With that, it's my honor to introduce today's moderator and speakers. Moderating today's webinar is USEA's Consensus Program Director, Mike Moore. Mike asked that I skipped his bio in the interest of time. However, if you'd like to access it, please go to usea.org and click on staff. Our speakers today are Ken Ditzel, Peter Connors, Fengrong Lee, and Joshua Emmett. Ken is Managing Director at FTI Consulting. He has 20 years of experience in energy market analysis and consulting. He began his work in CCUS in 2004, working on behalf of the National Energy Technology Laboratory on integrated gasification combined cycle market penetration. Peter is a tax partner in the New York office of Orrick, focusing his practice on cross-border transactions. He also has extensive experience in many areas of tax law, including corporate transactions, financial transactions, and tax controversy matters. Fengrong Lee is Managing Director at FTI Consulting, who has spent over 20 years in the energy sector and in commodity trading, holding senior positions with global energy and trading companies. She specializes in market advisory, strategy development, and utility resource planning. Joshua Emmett is an associate in Orrick's New York office and is a member of the tax group. He focuses his practice on a broad range of federal income tax matters with an emphasis on renewable energy investment and energy tax credits. From a logistics standpoint, we will hold off on Q&A until the end. If you have any questions, please feel free to enter them into the Q&A box or the chat box, and we'll address as many as possible based on the time that we have available. So with that, I'm going to pass it over to Mike. Go ahead, sir.
Alex, thank you very much for the introductions and getting us off and running. And thank you to everybody who's taking the time to be with us today for this webinar on the works that it's an overview of the study that the team has done, both teams have done, looking at the opportunities and issues and hurdles around some of the credit, that 45Q tax credit, incentives, structures, and of that nature. We're in a thick, heavy focus on CCUS, and at the high level, the PowerPoints always work when you connect all the dots with the equipment, the locations, the geographic area, and the opportunity. But when you dig down into the weeds, there's a lot of small nuances of how this may work better in some cases or rather than others. And we hope that the study that they were able to put together began to highlight some of the opportunities, some of the hurdles, and maybe some of the things we can have and help others work on and bring and make it more fruitful and useful. With that, I'm going to turn this over to Ken. And I want to thank both the FTI team and the Orrick teams for putting the time and effort into this. I'm not going to ask, but my assumption is the time spent was probably a lot more than I had anticipated, and we're certainly appreciative of it. And I think you and the audience will certainly appreciate the hard work that they've put in, bringing a lot of these issues and points and opportunities to the table in a way that are useful. Ken, it is all yours, sir.
Well, thank you, Mike. Fengrong Lee and I would like to extend our thanks to you and the USEA team and DOE for all their support that they've given to us throughout the process and getting this paper across the line. We'd also like to thank the Orrick team, Peter Connors and Joshua Emmett, for all their insights into the tax strategies, applications of 45Q and CCUS. Today, we're going to give you an overview of the report. I'm going to begin with a landscape of CCUS. Then I'm going to hand it over to Peter and Josh to talk about 45Q, 43 credits, state tax incentives, They're going to discuss California's low carbon fuel standard and potential partnership structures. Then I'm going to end with a discussion on roadblocks, hurdles, and solutions. It's important to recognize that the US is already a global leader in CCUS. The technology and set of technologies surrounding CCUS have been around for decades. The US hosts 10 of the 21 large-scale projects operating worldwide. These projects capture 25 million metric tons per year of CO2 and represent 67% of global CCUS capacity. As you can see from the table on the bottom right-hand side of the slide, the projects vary in terms of type from gas processing, industrial, power, hydrogen, and biofuels. CCUS is critical to achieving the 2 degrees Celsius goal. According to the IPCC, meeting the 2-degree goal will cost 138% more without carbon capture. In fact, the IEA Sustainable Development Scenario shows that CCUS will account for 7% of cumulative global emission reductions by 2040 and 20% annually by 2050 or mid-century. To get there, though, we're going to need rapid scale-up of CCUS and deployment of CCUS, going from around 30 to 40 million tons per year of capture to about 2,300 million tons per year by 2040. That's a 2 orders of magnitude increase. It seems distant from today's perspective to 2040, 2050, but we can do it. And here's why. We have a robust pipeline of project opportunities in the US and projects under development. In fact, according to the Great Plains Institute, there are 400 plus near and medium term capture opportunities using the 45Q credit in the US. Of these 400, more than 30 CCUS projects are under various phases of development. As you can see from the chart, power represents about half of those projects at 17 projects or 17 gigawatts and about 60 million metric tons of carbon captured per annum. The remaining 50% of projects are divided between industrial, gas processing, hydrogen, cement, direct air capture, and biofuels. And notably, biofuels represents about 25% of the proposed projects. At this point, we want to do a brief survey among the audience. Alex, if you could bring that up. And the survey question is, of the 400 near and medium term opportunities, how many do you think will ultimately become operational by 2030? Less than 30, 30 to 50, 51 to 100, and more than 100.
We'll give it another 10 seconds or so.
Great, thanks, Alex. Not too surprised by the survey results. We have a somewhat pessimistic group here, but I'm a little bit more optimistic. The survey results show that the majority of respondents thought that less than 30 of the proposed or the projects under development would actually go online by 2030. I'm a little bit more optimistic than that, and here's why. If we take a look at the estimated capture only cost by facility, and we look at the first tranche here of the projects in orange, we see that there's ammonia production, natural gas processing, and ethanol production. These projects already emit CO2 in a very concentrated stream. And the next step really is to capture that CO2, to compress it, dehydrate it, remove contaminants, and compress it for pipeline. In terms of ammonia production, there are about 30 to 40 different facilities in the US. Ethanol, there's over 200 facilities. And natural gas processing, there are over 500 facilities. Now, of course, not all of these will become economic, but if you take those 700 to 800 facilities and you roughly do a conservative cut of that of about 10%, you could say that 70 projects could become viable by 2030. And these projects are cost effective at $20 to $30 per ton, well below the $50 per ton 45Q credit. Now, looking at coal power plants in the next tranche of the light blue, coal power plants can reduce CO2 at about $40 to $65 per ton. This is right at the margin of the 45Q credit. Those projects that are on the lower end of the $40 per ton, if you add in $10 for transport and sequestration, you're right at the $50 per ton credit. But of course, that's on a after-tax basis. So there are some pre-tax factors that have to be considered. Moving to the third tranche in the dark blue, you'll see that it's mostly gas-fired power plants. These plants emit CO2 in very low concentrations, and thus it's harder to capture the CO2. However, I'd like to put a little asterisk around that and note that there are innovative technologies out there like the alum cycle that capture or that produce CO2 at nearly 100% rates and could drive down costs closer to those of ammonia production, natural gas processing, and ethanol production. And the costs are declining. In fact, two projects, coal-fired power projects that have come online in North America, Boundary Dam in Canada and Petronova, have reduced their costs substantially. With Boundary Dam around $110 per ton, that project came online in 2016. Petronova around $65 per ton, and that project came online in 2017. Going forward, two projects that are notable are the Shan project in Canada and the San Juan Generating Station in New Mexico, both in the $40 to $50 per ton range. DOE expects CO2 capture costs from coal-fired power plants to reach $30 per ton by 2030, and the International Energy Agency expects coal-fired capture costs to reach $22 per ton. Just to give you a sense of power projects around the US, they're looking to use the 45Q credit. The states in dark blue are states with gas-fired power projects, and the states in light blue are coal-fired projects that are under consideration in different forms of development. I think what's notable from this chart and this map is that these 45Q projects are quite diverse and range across the country, which is important because of the different climate factors, weather conditions, and also the different geology. So it's very supportive of long-term CCUS development in the power sector. With that, I'm going to turn it over to Peter Connors and Joshua Emmett to discuss 45Q and 43 credits.
Thanks, Ken. So why don't we move on to the next slide? Yes, 45Q has been in the tax code since 2008, but it was substantially overhauled in 2018 with the passage of the Bipartisan Budget Act in 2018. And now the credit is a very generous credit that extends for a 12-year period beginning at the time when the carbon capture equipment is placed in service. The credit is awarded based on the number of metric tons of carbon dioxide that are captured, and it is $35 per ton for qualified carbon dioxide used in enhanced oil recovery, and $50 a ton if the carbon dioxide is stored in secure geological storage. And after 2026, the credit amount is increased by an inflation adjustment. So in 2026, we cap out at 35 and 50, but it will go up with inflation. Now the credit is also available for, I mentioned it's available when it's used for enhanced oil recovery, but it's also used in certain processes, like the creation of biofuel, or where there is a chemical conversion of the qualified carbon dioxide to a material or chemical compound in which the carbon dioxide is securely stored. And it's also available in just a broad variety of categories, where there is a commercial market for the use of CO2, like the food and beverage industry. Of course, we're waiting for the IRS to provide guidance on what is a commercial market, but we should be seeing that guidance very soon. So the bottom just summarizes the amounts of the credit: $50 a ton for geological storage, and $35 a ton for the enhanced oil recovery, enhanced gas recovery, and utilization. So why don't we go to the next slide? Now, one of the unique things about 45Q is it allows the owner of the carbon capture equipment to transfer the credit to the party involved in the disposal, injection, or the utilization of the carbon dioxide. That's a change from the original 2008 legislation. Another important factor here is that the construction of the facility that will capture the carbon must begin before January 1, 2024. Now, the IRS has issued various guidance in this area. It has issued a notice on when construction begins. It has also issued a revenue procedure that provides a safe harbor for special allocations for partnership structures. And then they also issued in May 2020 proposed regulations that cover many, many points. And just here are a couple of the highlights. There are 7 takeaways from my point of view. One is the regulations cover the contractual provisions required when the owner of the carbon dioxide equipment contracts with another for the disposal, injection, or utilization of the carbon dioxide. The proposed regulations also provide a number of definitions, including the definition of carbon capture equipment. They also introduce a so-called 80-20 rule, allowing existing equipment and facilities to be retrofitted so they qualify for the higher level of credit. The proposed regulations also address the requirements and methodology for transferring the credit to the party that disposes, utilizes, or uses the carbon dioxide. The proposed regulations also introduce alternative rules by which Class 2 wells comply with the standard for secure geological storage. And the proposed regulations also address a very controversial point, and that is when and how much of the credit can be recaptured when there is leakage. So let's go to the next slide. Now, in addition to 45Q, which provides this very generous per ton captured credit, another area where there might be a tax incentive in Section 43, the enhanced oil recovery credit. There is a credit under Section 43 for the costs incurred with qualifying enhanced oil recovery projects. And that credit is 15% of the qualified enhanced oil recovery costs. The credit is phased out, however, if the reference price of the oil for the prior year exceeds an inflation-adjusted benchmark. And from 2006 to 2019, the benchmark price resulted in the complete or nearly complete phase out of the credit. Let's go to the next slide. But the situation in 2021 is likely to change. The inflation-adjusted amount for 2021 will be approximately $50. The reference price per barrel of crude oil will be based on the average price of domestic oil 2020, which is expected to be much less than $50, possibly as low as $40. And the phase out of the enhanced oil recovery credit only begins when the reference price per barrel of crude oil is greater than the inflation-adjusted amount. Thus, it's reasonable to expect that the full amount of the Section 43 enhanced oil recovery credit will be available. And again, that's 15% of the qualified costs. So let's go to the next slide. So what are the open issues? Well, despite the fact that we've had 3 forms of guidance: the notice on the beginning of construction, the revenue procedure on what is required to meet the partnership safe harbor, and the proposed regulations, there is still many, many questions that need to be answered. One of the most basic questions is, what is carbon capture equipment? The definition of carbon capture equipment was relatively narrow in the original notice, but it was expanded in the proposed regulations, and perhaps inadvertently, and it now covers almost all aspect of carbon capture processes. And it creates the possibility that if a historic process was being used secondarily to capture carbon dioxide, that historic structure, like a red oil plant, might be considered carbon capture equipment. So we're hoping that the IRS will provide a more precise definition of carbon capture equipment. Another question that comes up is whether the party that is obligated to dispose of the captured carbon dioxide can subcontract with the third party to carry out that obligation. You would think that that would be almost an obvious point, that if you have the contract with a third party to do the disposal, that they don't have to do the work themselves, but it's actually not clear at all in the regulations, and that needs to be clarified. Another question that comes up is regarding the assignment structures. And I mentioned that there is a partnership safe harbor that is set forth in the revenue procedure. Well, that safe harbor focuses on a partnership that owns the carbon capture equipment and captures the CO2. But we know that the credit can be assigned to the party that does the disposal of the CO2. And so the question that remains is, can that partnership structure be used in the assignment structures? And going back to the utilization point, I mentioned that one of the avenues in which the credit is available is for CO2 that is used in commercial markets. And there's just a vast number of opportunities to use CO2, starting simply with the food and beverage industry. And we're waiting for guidance from the IRS on what is a commercial market. That provision is not, of the code, is not operative until commercial markets is defined by the IRS. Now, on the legislative side, there are a couple of things that we need to be considering. The first is, when must construction begin? There's quite a series of legislation that has a tax component. The legislation is laid out in the study, but one that is, I think, is very likely to be enacted is one which deals with when construction must begin. And as I mentioned earlier, construction must begin before January 1, 2024. The question is, will that date be extended? And it will need to be extended by statute. And there are two bills. One would extend it 1 year, another would extend it 2 years. Another issue that comes up is whether or not the credit will be a refundable credit. In other words, right now the credit can only be used to offset the taxpayer's liability. And there are various limitations on when the credit can be used and to offset various taxes that might arise. There have been proposals tied in perhaps to the pandemic to make the Section 45 credit refundable. And there are two legislative proposals. One would provide the credit, but it would give the credit or attach a discount to the credit of 10%. Another, in the Forward Act, would also give the credit, but would discount the credit by 15%. And then a further issue that comes up is that if we do have this refundable credit, and therefore there is a lesser need for tax equity investors, will there still be a market for tax equity investors that provide important financing to the renewable structures? So those are the key open issues. We'll come back to the partnership structure in a few minutes. And now let's just talk about some of the state tax issues.
Thanks, Peter. So we reviewed a sample of states that have incentives for carbon capture and sequestration. We found that the incentives tend to match the taxes that the state imposes. The types of incentives include property tax exemptions, sales and use tax exemptions, severance tax credits, gross receipts tax credits, and corporate income tax credits. And then if we go to the next slide, we found that Texas has the broadest set of incentives for carbon capture and sequestration of the states we reviewed. So I'll quickly kind of give an overview of how taxpayers in Texas could qualify for those incentives. At a high level, Texas has authorized franchise tax credits, reduced state severance tax rates, sales and use tax exemptions, and gross receipts, and some other tax exemptions. Many of the incentives include a requirement that the project be a clean energy project. Those can be coal-fueled, natural gas-fueled, or petroleum coke-fueled electric generating facilities. And they also have a few other requirements. They must be a certain size, they have to be at least 200 megawatt. They have to capture at least 70% of the CO2 resulting from or associated with the generation of electricity from the facility. And they must be capable of permanently sequestering in a geological formation the CO2 captured and be capable of supplying the CO2 captured for purposes of an enhanced oil recovery project. One reason I picked Texas to go over was because we found it interesting that the definition and requirements touch on some of the same points that come up in the 45Q context. There's a requirement to be a certain size of project, and you have to capture a certain proportion of CO2. With 45Q, electric generating facilities have to capture a certain amount of CO2. This facility emits less than 500,000 metric tons of CO2, has to capture at least 25,000 metric tons of CO2. And if the electric generating facility emits more than 500,000 metric tons of CO2, it has to capture at least 500,000 metric tons of CO2. So even though they use different metrics, it's kind of getting at the same point. One other interesting thing where Texas and 45Q diverge a little bit is on the definition of sequester. In Texas, it's defined as injecting CO2 into a geological formation in a manner and under conditions that create a reasonable expectation that at least 99% of the CO2 injected will remain sequestered from the atmosphere for at least 1,000 years. So something that was interesting is that this reasonable expectation standard is used. Whereas with 45Q, there's a lot of rules that Peter touched on around the recapture where CO2 escapes back into the atmosphere. And then if you'll go forward another slide, and actually one more. So I'll quickly go through California's Lcfs program. This is another approach to incentivizing carbon sequestration. It's the Lcfs program in California is a regulatory program that's designed to encourage use of cleaner, less carbon intensive vehicle fuels. And it has recently been amended to recognize carbon capture and sequestration as a method of reducing the carbon intensity of fuels. Under the Lcfs program, each supplier of vehicle fuels in California is required to achieve a benchmark standard of carbon intensity of the fuels it supplies in the state. So suppliers of vehicle fuels can submit fuel pathways for approval under the Lcfs. The pathways take into consideration the sum of greenhouse gases emitted through each stage of the fuel's production and use. This is the life cycle analysis. And the carbon intensity of the fuel is calculated from this. If the carbon intensity is lower than the benchmark, it generates a credit, and that credit is purchased by the fuel supplier selling fuels that have a carbon intensity greater than the benchmark. So although no pathways have been approved under the Lcfs, the legislation does contemplate that CCUS is a way of qualifying for the credits. The California Air Resource Board has provided four avenues for generating Lcfs credits using carbon capture projects, and those are listed on the slide. And if you advance to the next slide, There's an active market for LCFS credits, and the credits are valuable. You can see here the price of the credit and the volume of the credits transacted and how it's been increasing in recent years, and it's expected to increase further as time goes on. And then if we advance to the next slide, we can get back into the, oh, sorry, one more. The potential partnership structures. I'll pass it back to Peter to start us off.
Let's do a polling question, Alex. Yes, so our polling question is, have the proposed regulations released by the IRS and Treasury in 2020 increased or decreased the likelihood of pursuing a project that would qualify for the Section 45Q credit? And the possible answers are increased, but the guidance clarified the critical issues, or increased, but there are still ways to go, decreased, the guidance unclear with respect to critical issues, or finally decreased, the project being suited would not qualify the 45 credit under current guidance. So let's, please respond to the polling question.
I'll give another 5 seconds or so.
And so the vast majority, 74%, say that the regulations have increased the likelihood of having a project, but there are still ways to go. And a lesser amount actually says they've increased the guidance actually clarify the critical issues. Well, thank you very much for responding. Now let's just talk about the partnership structures. I mentioned early on that the IRS had issued a revenue procedure providing a safe harbor for special allocations that would normally be seen if it were a tax equity investor. And to just go over that point once again, a tax equity investor would like to get almost all the tax credits generated from a project. To be entitled to the vast majority of the credits or a special allocation of credits, the IRS issued a safe harbor which set forth certain criteria pursuant to which the allocations in a partnership agreement would be respected. And generally what you'll see is that 99% of the income loss and tax credits will be allocated to the tax equity investor until a agreed upon IRR or a certain time period is reached. And after that flip date, then the allocation changes to something like 5% to the tax equity investor and 95% to the developer. Now, this diagram illustrates, in fact, the structure that was in the revenue procedure that was issued in February. And at the center of the chart is the project company. The project company is a partnership depicted by a triangle. The tax equity investor is the box up on the right-hand side of the screen. The developer is on the left-hand side. The project company will acquire the carbon capture equipment. It will then enter into an agreement with the power plant that is emitting the CO2 or the unprocessed CO2. And the project company / partnership will then capture the CO2 from the power plant or the interested facility. And then we'll enter into an agreement with some other third party to acquire, to sell the CO2. And that might be for enhanced oil recovery, or it simply might be to have the CO2 sequestered. So that agreement is referred to as an offtake agreement. So this would be where we'd expect most deals are going to, what most deals are going to look like. And certainly we've been working on deals at this point that are taking this format. The variation on the structure might be that the CO2 may not be used for enhanced oil recovery. Rather, it may be simply piped into a Class 6 well and sequestered in a saline mine. But I think this is the basic structure that you'll see. And once again, it's referred to as the partnership flip structure because the allocations change from 99 to 1 to 5/95 at the flip date, which is the time at which the investor has met its return, the IRR, or perhaps just the date certain. So why don't we go to the next slide? So the again, one of the unique parts of 45Q is that the credit can be assigned to the party that disposes of or injects or utilizes the CO2. And here we've put the project company, the triangle, with the investor to the right side of the screen. So on the left side, we're seeing the carbon capture equipment and the power plant. And we have an agreement where there's an offtake agreement. So the offtake agreement is transferring the CO2 to the project company, and along with the credit. So the question that comes up is, well, will the partnership safe harbor apply if in this type of structure where the assignment of the 45 credit is given to the project company? In other words, can you do special allocations for the tax equity investor in an assignment structure? Or if not, do you have to just do a straight up allocation to all the different partners in the partnership? In other words, you could have a partnership without special allocations, but if you're going to have a tax equity investor, you typically would like to have the 99-1-5-95 flip structure that is discussed in the red block as a safe harbor. So those are the two likely structures. We don't know at this point whether or not the second structure will work. Hopefully that's one of the items that will be addressed when the IRS issues final regulations. Okay, so that covers the partnership structures.
Great, thanks Peter and Josh. Let's move on to roadblocks, hurdles, and solutions. In our report, we discussed the very interconnected nature of some of the major roadblocks, hurdles, and solutions facing CCUS projects. And we identified 4 of them. Governmental regulatory is 1. Number 2, public perception. 3rd, financial market. And 4th, technical improvements. And the way to think about this is, let's give an example. With the 45Q, that's a governmental or regulatory factor that then affects how the financial community and markets respond to CCUS projects and incentivizes them to invest. With that investment, over time, we see technical improvements, either learning by doing or innovative technologies that reduce the costs of CCUS. Together, those 3 all affect public perception on the viability of CCUS. So at this point, we'd like to ask another survey question. Alex, go ahead. What's the biggest set of roadblocks, hurdles that will challenge the first wave of CCUS projects in becoming operational by 2030? Is it governmental or regulatory, public perception, financial market, or technical improvement?
We'll give it another 5 seconds.
Interesting, financial market with 48%, and in second, governmental regulatory 32%. So thank you all for responding to that. Moving on to the next slide. Let's talk about some of the key roadblocks, hurdles, and solutions, beginning with governmental and regulatory. I'm going to focus on state and federal here. and give a few examples. At the state level, one of the biggest hurdles is that many existing state programs encourage renewables, but not really other low or zero carbon approaches. So in the report, we identified hurdles and roadblocks such as these and came up with a set of solutions. And for the example of the state programs that encourage renewables, but not other low or zero carbon approaches, one solution could be adapting renewable portfolio standards, or RPS. They could be modified to include CCUS, enabling more advancement of CCUS and adoption of CCUS by the market. On the federal side, one of the biggest issues in talking to many potential investors, owners, and operators interested in the 45Q credit is that the default requirement for monitoring is 50 years, or at the discretion of the EPA administrator. There's a lot of at least perceived risk in that, and there's really no insurance solution covering that kind of time period or that amount of risk. So potential solutions there could be government assumption of liability for early mover projects to incentivize and de-risk and help create the market. Another solution would be a transfer of the liability risk and oversight to the government when secure geologic storage is demonstrated, likely with some operators paying a fee into a stewardship or trust fund, almost like what nuclear operators owners pay for storage. Now, moving on in terms of governmental regulatory roadblocks, I want to kind of delve in here into the Class 2, Class 6 issue that Peter referenced earlier. In terms of CO2 storage potential, at least in the US, the vast majority, over 95% of that potential, is in saline aquifers. Those are Class 6 wells. Class 2 wells, on the other hand, are oil and gas reservoirs. What is interesting here is kind of the dichotomy between oil and gas reservoirs and saline, in that there are over 180,000 Class 2 wells in operation currently, whereas for saline aquifers or saline sequestration, there are only 2 class wells, and those are both located at the Archer Daniels Midland Decatur ethanol facility in Illinois. So there's a long way to go in terms of getting investors comfortable with Class 6 wells. It's been studied for many years, and it's been proven to be effective and able to secure the CO2 underground, but there is still that perceived risk just simply because there aren't that many wells. The other issues are just timelines and costs. The permitting timeline for a Class 2 well is about a year. The costs are less than $100,000, and annual monitoring is around $4,000. On the other hand, for Class 6 for saline aquifers, you're looking at a permitting timeline of around 3 years, permitting costs of over $500,000, and annual monitoring costs for around $320,000. Currently, there are only 2 states that have primacy or the ability to permit Class 6 wells at the state level. Remaining states or entities in other states would have to go to the EPA. Those 2 states that have primacy are Wyoming and North Dakota. One way of advancing Class 6 well adoption is by encouraging states to seek primacy. Other roadblocks, hurdles, and solutions are certainly in the public perception area. You can divide those among 3 categories: socio-political acceptance, market acceptance, communities acceptance. And just focusing here on communities acceptance, a number of facilities are in communities that support the community's jobs and economics. You can think of ethanol facilities, coal facilities, gas processing facilities. Portions of that community could be very receptive towards prolonging that plant's life by putting on CCUS equipment. Other portions of that community could be against any additions to the facility, pipelines, storage of CO2 underground. So it's very important for investors and various stakeholders, regulators, policymakers to kind of understand the different attitudes that shape people's opinions and communities' opinions on CO2 capture, transport, and storage. And those are, in terms of solar and wind, for example, a lot of those issues have been kind of hashed out just by the amount of solar and storage that have come online. But this is in some ways a new opportunity for a new a new technology that people just simply aren't aware of. And so solutions are socio-political acceptance, getting the media engaged, and getting policymakers engaged in understanding CCUS and the benefits of CCUS. Just touching on the last two sets of roadblocks and hurdles, there are certainly technical roadblocks, and achieving those or overcoming those roadblocks and hurdles, the primary way is just enabling more learning by doing. And that's getting more plants online. And how can you do that? Well, developing a robust federal direct air capture, research development, demonstration, and deployment, or RD&D program, expanding support for federal carbon utilization RD&D programs, federal RD&D investments in carbon capture, utilization, storage, and removal, and then also some cost sharing on the front end engineering design or FEED studies will certainly help technology move along. In terms of financial/market roadblocks and hurdles, there are two primary ones that we're highlighting here, many more in the report. The first one is decreasing regulatory uncertainty, along with lowering and narrowing the range of CCUS costs. Solutions could be clarifying CCUS pipeline permitting review process, extension of the 45Q credit, as Peter had mentioned earlier, expediting CO2 pipeline permitting, providing loan guarantees, and again, cost sharing of FEED studies. Another roadblock and hurdle is investors in renewable energy deals must use a hypothetical book value method to present the results of their investments on their financial statements. And with that, I'm going to turn it back to Peter so we can discuss that a little bit further.
Yes, and so any investor that enters into tax equity investor that enters into a partnership flip structure will be concerned about the financial statement presentation of the investment. And if they do enter into a partnership or into a structure that has this flip feature, they're going to be required to use the hypothetical liquidation book value method to present the results of their investment. And under this approach, the expected amount each partner would receive is calculated at the end of the year as if the partnership were liquidated. It's like a mark-to-market method of accounting. And the issue with this method is that the losses, or let's say income or loss, but probably loss in the early years, will go directly onto the financial statement as a separate component of operating income. But and then, of course, those results are not going to be linear. They're going to be whatever it is from year to year, however the partnership operates. And of course, most of these projects are going to be generating losses in the early years. But then the other question, though, or the issue that makes it more complicated is the tax benefit. The investor's only going to go into the structure if it's going to get a significant tax benefit in the form of the 45Q credit. Well, those 45Q credits are going to be reported separately in the effective tax rate calculation. So you're going to see the results from operations on the income line, probably losses, and you're going to see the tax benefit, which is very often the most important driver from the investment, in the effective tax rate calculation. So you're going to have losses that are overstated or that might not even exist if the tax benefit were included in the same component of the financial statement as the mark-to-market pursuant to the hypothetical liquidation book value method. So that is a real issue, and it's not an issue that is unique to carbon capture investment. Rather, it's an issue that permeates all partnership flip structures involving renewables. We see it a lot in the wind deals. Now, some investors are very large so that it doesn't matter whether or not they have a loss from this particular investment, or perhaps they're using they're a large bank and they're able to use some historic accounting method. But for the mid-sized investor that is going into a deal like this, or a a wind deal, for instance, a wind production credit deal, that will be a big factor in whether or not the deal is something they're able to go into, because again, it overstates, it creates a financial statement loss by not showing the tax benefits separately. So it's a problem that permeates the entire renewable industry. And while some of the big banks and some investors have gotten around it, mid-sized investors are going to be really concerned about it. So that comes to the conclusion of this slide. Shall we go to Q&A?
Sounds good. Go ahead, Mike. Do you have any questions from the audience?
Yeah, Ken, Peter, Joshua, and Fengrong, we've got a couple have come up, and I've had a couple of emails come in indirect. So the first one that pops in, by the way, great work, great presentation on that, some great new points of interest that I think will be some good takeaway insights for the folks that have attended with us. So Jason Selch asks, is there a start of construction date for the EOR or the sequestration field?
I think I'll take that, and I don't think there is. I think it's simply going to be, the focus is based on the date that the carbon capture equipment is placed in service.
Okay. Anybody else want to respond to that, or?
Yeah, that's my understanding too, Mike.
All right, thanks, Ken. Have Jason again. Does the low carbon fuel standard credit take into account the carbon intensity of the electricity used by the refinery? Can a refinery get credits by using low carbon electricity like solar, wind, or CCS generated power?
Sure, I can take that, Peter, unless you want to.
No, go ahead, Ken.
Yeah. So there's various pathways under the Lcfs, and it's a life cycle type of analysis. So yes, it would consider the electricity. So potentially with lower carbon intensity electricity coming from a CCUS facility, that would enable a new pathway that would have to be considered under the Lcfs.
Okay. One of the things that maybe might be interesting to pursue is what can the states do to foster interstate CO2 pipeline development? That's kind of some of the folks that have been our attendees know firsthand the work and effort required. But I'm wondering if you have some other ideas that about for the states where CO2 pipelines might be slated to go, what can be done state to state, internally, and in process?
Sure. So considering interstate pipeline projects, one of the approaches could be to streamline the permitting process by engaging with stakeholders to understand their concerns and identify some of the roadblocks and hurdles and solutions. Also, another approach states could take would be to band with other states in terms of trying to make the permitting process similar, so that project developers, let's say an ethanol facility in Iowa wants to put in a pipeline, they want to pursue almost the same process as much as they can in Illinois if they also have a facility there. So states that make the process similar across state boundaries would be extremely helpful. Also, states can get ahead of the curve, I think, by studying possible routes for locating pipelines and where those facilities might be located, and also looking at existing right-of-ways.
Okay, thank you for that. I think that there's work that's been going on that the Carbon Capture Coalition has been working with some of the states to do part of that pre-mapping or route identification. It's been a high-level study that's been done. So there are, I think at a state level, there have been states that have begun to think like that and begun that process, I think in the Western states. John Owen gave us a question. Storage in an aquifer is just a cost. Monetization of CO2 is a better avenue for CCU. Can you talk about the monetization of CO2?
Sure, there are several routes to monetizing CO2. Obviously, EOR or enhanced gas recovery is one method. Another method is the utilization of CO2 in other industries such as food and beverage, capturing it in cement, strengthening cement, et cetera. There are a number of different routes for using CO2. I think maybe Peter might want to comment on what some of those commercial uses might be, or at least the need to clarify some of those commercial uses.
Yeah, I would agree with that. It's really an open field at this point. I've just seen lots of commentary on just different potential uses of CO2, but with the food and beverages coming to mind, obviously carbonated beverages all need CO2. But I just, the field is open in terms of what the possibilities are. And of course, as Ken said, you know, we really don't know what the commercial markets are until the IRS issues some type of guidance on that. So it's, I think that people are really thinking about it right now. I've seen some LCA studies related to utilization of the CO2, but people are kind of just thinking about what the opportunities might be.
Right. I have some more of a comment from somebody rather than a question. It's couched as a question. It's about the production of ammonia and the process and the sequestration of CO2. Is it, since there's a lot of stranded gas, have you seen, or do we expect to see more interest in utilizing stranded gas for conversion to ammonia? And if there's a CO2 output, and of course, CO2 needs to find a home, either monetized in EOR or direct storage into brine. I guess it's more of a, like I said, more of a statement than a question, but I wanted to put that out on the table in case somebody wanted to comment. That was James Grieve.
Yeah, Mike, I assume by stranded gas, they mean, you know, some of the gas that we see in like the Permian or the Bakken.
Right.
Yeah, okay, good. Sure, I mean, there have been a lot of ideas around capturing that gas and using it by, you know, putting in pipelines, you know, making the power directly there. Ammonia or other chemicals would be another idea. I mean, people have even discussed LNG by rail as potential options for some of that stranded gas, but certainly mitigating some of that stranded gas and the CO2 emissions associated with it, the chemical route, particularly ammonia, would be an interesting pathway.
Several people have asked, how do we get a copy of this great slide deck? That's not for you all, but we'll explain in the end. It'll be available on the website when we put the recording of the session up, as well as the study that was released prior to this and why we're having the webinar, and in the webinar materials itself. John Wynn, again, pipelines are clearly in the target sites of NGOs and others. And how do you get them permitted there when they're blocking all pipelines everywhere? Especially back here, back east, we see that probably a lot more frequently than some of the states that have been doing this for a long time.
I would hope that, you know, people would see the hypocrisy in blocking CO2 pipelines if you're trying to mitigate CO2 emissions. I mean, I think a lot of those folks that are trying to block natural gas pipelines are, you know, anti-fossil. So, you know, I would hope they would realize that, you know, blocking a CO2 pipeline doesn't help their cause.
Yeah, I kind of agree with that point, because, you know, most of the pipeline, or the advocacy against the pipelines has been for fossil fuels. And here, if you can specify that it's being used and dedicated to carrying out CO2, I think that would actually, you know, be a nice argument to make to that constituency.
Well, I'll tell you what, it looks like we're going to be able to cut it right at 2 p.m., our window. There was another couple of comments, and just for the fact that he took the time to put them in, Esteban Kalmar, they weren't directly related to everything we were talking about. One was he was wondering where there might be funding for the first $100,000 for finding ways to fund revolutionary technologies. What I would offer to him that the DOE is constantly issuing FOAs out there, looking for new ideas with some various funding opportunities. And he also went on to make comments about the renewable sector has issues with rare earth elements. And if the US and China bump a little harder, that might create some issues for further deployment of renewables that require a lot of rare earth elements. How do you cover distance? And of course, if it's for power generation, we have fossil fuel generation to have CCUS to offset what we might lose in renewables. With that, I'm going to wrap this up. Ken, Peter, Pengong, and Joshua, thank you again for the work you guys did on the study. Thank you for taking the time today to give us the overview of your work, and great stuff. And to the people that took the time to stay with us and register to be part of this, thank you. We want to thank the Department of Energy, Fossil Energy, for their support of these programs. And then I need to give special thanks to Alex and Michelle and Will and our group who allow the consensus program to operate and get done here. So to everybody, thank you all very much. Alex, I'll let you if there's anything else we need to do for housekeeping. And
Thanks, Mike. Again, I just want to reiterate a thank you to all of our presenters. This has been very informational on really a quite important topic, at least in our opinion. If you missed any of the webinar or would like to share it with any of your colleagues, we will have a recording and a copy of the presentation posted on our event page on usea.org. You'll be notified and provided with a link when everything is uploaded. In the meantime, please be on the lookout for our future webinars that we'll be hosting, including CCUS in Texas, stakeholder feedback on the Office of Clean Coal and Carbon Management Strategic Vision, and a look at various state regulations that apply to CCUS and EOR. So with that, thank you for joining, and we hope you have a good rest of your day.
Thank you. Bye.
Thank you.